Welcome back to Coffee with CRS and our series on the Big Beautiful Bill. I'm Jody and I'm here with Fancher. Today we're talking about the Qualified Business Income Deduction, or QBI. Fancher, what is QBI and can I eat it?
Well, if you like the taste of tax savings, absolutely no. But seriously, QBI is the net income from your business. So if you're a sole proprietor or a partner or even an S corp shareholder, it's your share of the profits, or basically it's just your share of the profits of QBI. So got to make that distinction. So it doesn't include things like your wages from your W-2, your investment income, or guaranteed payments inside a partnership.
Well, I definitely like the way tax savings sounds, and I'm sure I would like the way it tastes too. And what's the QBI deduction exactly?
So what the QBI deduction does, it lets an eligible business owner deduct up to 20% of their qualified business income from their taxable income. So it's like a big coupon for small businesses because it can lower their tax bill by thousands of dollars each year.
That sounds wonderful. What did the Big Beautiful Bill change about the QBI deduction?
Well, the biggest change is the deduction is now permanent. It was set to expire at the end of this year, but it's here to stay. There's also a new minimum deduction. So if you have at least $1,000 in QBI and you actively participate in that business, you get at least a $400 deduction, even if that 20% would be less than that.
That's great for really small businesses like those with the side hustle. What about the income limits and the phase outs?
Well, that's a great question. The phase-in ranges for the wage and investment limitations and for specified service businesses like law and accounting firms have been expanded. So for 2025, that threshold is now $394,600 for married couples filing jointly and $197,300 for single filers. If your taxable income is below those amounts, you'll get the full 20% deduction. If you're above that amount, the deduction starts to kind of phase out. And for certain service businesses, it can be limited or just eliminated altogether.
I'm glad that it was finally made permanent, but can you give us an example?
Sure. Let's say you're a single proprietor with $100,000 in QBI and $150,000 in taxable income. You get a $20,000 deduction, which is 20% of your QBI because you're below the threshold. Now, if you're a married couple, say with $432,000 in taxable income, and one of the spouses is a partner in a law firm, you're in the phase-in range. So only a portion of your law firm income would qualify for the deduction based on how far you go into that range.
Okay, so now we've learned about that, but what about the minimum deduction?
This is one of my favorite parts about the new laws. So say you got only $1,200 in QBI from your side hustle. So under the 20% rule, that would be $240. But the new law says you get at least a $400 deduction thanks to that new minimum.
That's $160 more. That's wonderful. So the QBI deduction is now more accessible and permanent with the safety net for small business owners?
Exactly. It's like a parachute, just in case your profits aren't sky high.
Thanks, Fancher. Next time we'll talk about bonus depreciation and Section 179 expensing. 2 more ways the Big Beautiful Bill helps small businesses invest and grow.